Hello, and welcome to my new channel, 10 Baggers. This is a channel for young investors who want to discuss growth stocks, have a little fun, and get a leg up on Wall Street. This video is intended to be informative and thought provoking. However, I'm not a professional advisor, so please take my ideas with a grain of salt. For what it's worth, I will always disclose my positions at the end of the video. So the topic of this video is about retailers and retail brands that have been beaten down by the CV thing in the past month. Obviously, a single event isn't going to cause companies to lose the majority of their value in a single week, as we have actually seen across multiple industries since the CV outbreak. This indiscriminate drop in stocks means that a few market inefficiencies may exist, and therefore there are opportunities to invest in great companies at cheap prices. One industry that has experienced a broad drop is the retail and consumer brands industry. This is an interesting industry to search for plays, as many consumer retailers have had to close their stores due to the outbreak and thus have had no foot traffic. Some brands have strong e-commerce direct-to-consumer presence, but will still suffer due to skyrocketing unemployment. And there's not going to be any doubt there's going to be some suffering among consumer brands in quarter one of 2020. If we look back at past recessions, we see that many consumer brands took massive hits in their stock price, only to survive the recession and become multi-baggers in the future. Three examples of this can be seen with apparel brand Lululemon, mattress manufacturer Sleep Number, and designer brands known for the shoe warehouse DSW. Let's take a closer look at Lululemon Stock, ticker LULU. After IPOing in 2007 at an initial share price of $14, the stock took less than 3 months to rally to an all-time high of $27. This was a rise of almost 100%. Unfortunately for exuberant Lululemon investors, the Great Recession of 2008 was right around the corner, causing share prices of Lulu to drop to $3 a share. In fact, it actually went under $3 at one point. The bottom was found at $270 in February of 2009. If you were a Lulu investor back then, hopefully you had diamond hands and held on to your shares and possibly bought more, because Lulu took off from there with the post-recession economy, stealing market share from other brands and riding the athleisure wave. Lululemon ultimately rose to an all-time high of $254. If you had actually held your shares from the all-time highs in 2007, you had a 10-bagger in February. If you had bought shares in 2009, you might have found yourself holding a 100-bagger. That's a stock with over 100 times return your money. Sleep Number and DSW followed their own stories and faced their own unique headwinds during the Great Recession, but both made it out big. Sleep Number ultimately was almost a 300-bagger from the all-time low to the all-time high, which recently occurred in February 2020. DBI stock also had a more reasonable, albeit awesome comeback after the Great Recession, moving from under $4 a share in 2009 to an all-time high of $46 in 2013. That's a 10-bagger in 4 years, folks. Okay, so obviously tough financial times bring about individual issues with individual stocks. However, I think that retail brands have been suffering more than they should be with the outbreak. I know that stores are closed, but many brands have e-commerce presence, which, although dominated by giants like Amazon and Wayfair, still has a ton of room to grow with the American consumer. I also know that 90% of retail stores are back open in China as of March 2020, so there's no reason to believe that people will both stay out of work and stores will be closed into quarter two of 2020. Because of this, I'm a buyer of consumer brands and retail brands in the stock market. Below, I will discuss 4 brands that I either hold a position in or I'm considering starting a position in based on a few factors. They should make it out of this outbreak and the possible following recession stronger than before. The factors I will be considering today are the company's balance sheet, most importantly, how much debt do they have, and do they have the cash to see it through during a downturn? The company's room for growth. Although a lot of my retirement portfolio is in big cap index funds, In my personal brokerage, I like to take on more risk. In this account, I usually like to pick companies who have plenty of room to grow in the American economy. Is the company riding a long term trend? For example, Lululemon rode the trend of yoga pants and athleisure, which became immensely popular in the 2010s. And I'm certainly not complaining about that. And is the management team strong? Can the management lead the company through uncertain times? This is the hardest to judge because it's a subjective opinion, and sometimes it's the person's first try. But in the best case scenario, you either have an owner operator who has skin in the game, think Jeff Bezos, or someone with prior experience leading companies through the mud of a recession. The first company we'll look at today is Tapestry Brands, ticker TPR, which is a holding company for three major consumer brands: Coach, Kate Spade, and Stuart Weitzman. The company hit a 52-week low of 1050 last week, which was a 64% drop from the prior highs of 2020. The company's balance sheet is strong, however, with over 1.2 billion in cash as of June 2019, compared with 913 million in current liabilities. That's a relatively strong position to be in heading into a recession, and at least ensures that investors that bankruptcy is an unlikely event at this time. TPR's room for growth is questionable, however. It is possible that the brand will expand into international markets such as China and Europe. And in addition to the international growth, the Stuart Weitzman brand is a growing operation which will continue to net more and more income for the brand in the coming years, as it has the potential to steal market share from other shoe companies. The company is riding two long-term trends. First, it is ratcheting up its direct-to-consumer capabilities as to not be reliant on a retail or e-commerce platform, and it is expanding into high-end men's fashion, probably not a market that was viewed as profitable in the past. Management is also strong with CEO Zeitlin at the helm. Zeitlin was an executive on the board of Goldman Sachs through the Great Recession, so he probably has experience leading a company through tough times. I do not currently own TPR at this time, but if you follow me on Twitter at 10xbaggers, I will keep you updated on my holdings every day. The next stock I want to look at is At Home Furnishing, ticker HOME. This is a brand trying to break into the growing e-commerce space of home furnishings, something that Amazon has had a particularly tough time doing due to the difficulty of shipping many types of home furniture like big bed frames and couches and stuff like that. Only time will tell if they are able to continue to take over the world and destroy this market for other companies. That being said, I think a good opportunity presents itself with At Home. E-commerce will continue to be a growing trend, and At Home is poised to challenge giants Wayfair. At Home has a troubling balance sheet, however, and despite its growing revenue for 4 years in a row, it actually posted negative earnings in quarter one of 2020. This is not a good sign right now, and we will continue to evaluate this stock every quarter through the CV crisis. I currently own 4% of my portfolio in HOME and have faith that the company will be able to continue the trend in their revenue growth and turn profitable with an increased scale in the future. The next is retail brand Tillys, ticker TLYS, which is a retail store started in California with over 200 locations. Tillys has a decent balance sheet and a strong e-commerce presence. They have proven to have some decent growth, albeit with a relatively stagnant stock price since an IPO in 2012. I like that they know their focus market, which is in the extreme sports space, and the fact that they only have 200 locations, along with their solid identity, is for me an indicator that they will grow in the future. One risk factor is that the brand does operate in malls, which is not a part of a growing trend, and the experience of management is nothing to write home about as of yet. Tillys is unlikely to go bankrupt because of their strong balance sheet and finally presents a decent value to investors at these prices. You might not have a 10 bagger here, but it's unlikely that you're going to lose a ton of money on Tillys. It's a solid value pick. I do not currently own Tillys, but I will keep a pulse on the situation and possibly average in. Again, if you want to know when I purchase, feel free to follow me on my Twitter at 10x baggers. Finally, last but not least, okay, this one's going to go over not so great, is Casper mattress, ticker CSPR. First off, this stock has a terrible balance sheet and questionable management. In addition to some negative sentiment about the fundamentals of the company, very negative, it may have IPO'd at the exact worst time to ever IPO. Sentiment on the street about the company drove the share price down, and then boom, we got into the CV situation. The company is not profitable, but it is recognized by 30% of American consumers. Even my mom has heard of it. And could eventually be the main player in the space, or the sleep economy as they like to call it. I actually do have 5.8% of my portfolio in the stock, but I only bought shares recently after what I feel to be a sufficient punishment by the street. My average cost per share is around $4.20. This is definitely a speculative play here. And again, I'll have to keep my pulse on the situation. If their balance sheet doesn't improve, even if I'm making money on this stock at this price, I probably will be exiting the stock if they don't turn profitable sometime in the near future. I don't see the company going out of business anytime soon, considering they just IPO'd and tons of venture capitalists have their hands in this. So it's likely that they would like to see a return on their money, although who knows. So anyway, that's my video. I hope you got some decent ideas to further your own research. If you want to continue the discussion about growth investing, be sure to like the video and hit subscribe. If there's any company you would like a little analysis on, don't hesitate to tweet me at 10x baggers. Thank you and have a wonderful day.